Welcome to the NPERS Social Security presentation. This presentation is designed to give our members a broad look at the Social Security program, as it is a basic part of many people's retirement plans. During the presentation, we're going to go over what makes you eligible for Social Security, how to calculate that benefit, and various other aspects of the program. NPERS does not calculate or administer Social Security benefits, so if you have questions about this program, or about a claiming strategy, please contact the Social Security Administration or a licensed financial planner. Social Security was established as a program in 1935 as part of FDR's package of New Deal legislation. It was designed to help retiring individuals who were affected by the more than 10,000 banks that failed, or the 25% unemployment rate that was going on during the Great Depression. Social Security is a pay-as-you-go system. What that means is that people pay into Social Security through payroll or FICA taxes, and this money is paid out as benefits to people who are currently receiving Social Security. It is designed to replace a portion of your income, that portion being approximately 35 to 40% of your average monthly earnings. The Social Security benefit is a benefit that is paid for your lifetime. Social Security has undergone a lot of changes throughout the years. It has grown and expanded into something more than it started out to be. It now encompasses survivors' benefits, disability insurance, and in 1965 there was the creation of Medicare. Almost 69 million Americans receive Social Security benefits. As of 2020, 40% of older Americans receive all of their income from Social Security. The reason that is important is you have to remember this program was designed to only replace 35 to 40% of your monthly income. And that is why it's important to have retirement savings to use in conjunction with your Social Security benefit so that you may retire comfortably. Additional benefits for spouses, widowed spouses, and children under 18 are available through the Social Security program. We're not going to cover these scenarios in our presentation today, so if you review this slide and believe that one of these scenarios pertains to you, please contact the Social Security Administration or review their website at ssa.gov. The contributions to fund the benefits that are paid out by Social Security come from our payroll taxes or FICA taxes. That's 6.2% of our first $147,800 in earned income. There's also an additional 1.45% tax that is allocated for Medicare on our entire income. Both of these are matched 100% by your employer. If you make over $200,000 individually or $250,000 as a married couple, you're also subject to an additional 0.9% Medicare tax. To be eligible to receive Social Security, you need 40 credits. You can earn a maximum of 4 credits per year, and this is based on how much you earn. Each year, the dollar amount for a credit can change. This year, if you earned $1,510, you have 1 credit. So, if you earn $6,040 or more, you've earned 4 credits, because you can only earn a maximum of 4 credits per year. With that in mind, it takes most individuals 10 years to become eligible for their Social Security benefit.
Now that we know what makes us eligible to receive a benefit, let's talk about how those benefits are determined. As we said before, Social Security is used to replace 35 to 40% of our lifetime average monthly earnings. So we'll need to know what our lifetime earnings were. We'll then need to place those into a formula that determines what percentage that we will get. Finally, our benefit amount will be greatly affected by when we decide to start drawing benefits. In determining your lifetime earnings, the Social Security Administration takes a look at your 35 highest years of earnings. They then apply an indexing factor to each year that brings all 35 years to current dollar values, because the dollar that you earned in 1987 is worth around $2.45 in 2022. These 35 highest years of earnings do not have to be consecutive, and the average, of course, is going to be decreased if we have lower years of earnings or years when we had no earnings at all. Now, Once all of your 35 years have been indexed to today's value, they determine an average of those 35 highest years of earnings. This is done by adding them up, then dividing by the amount of time which, in this case, is going to be 420 months, or 35 years. Our example here is $1,829,606, so we'll divide that by our 420 months. This gives us $4,356. That is our average monthly lifetime earnings. Now we need to drop that number into our income replacement formula. Once again, Social Security is designed to replace only a portion of our income, so that's what this formula does. The lowest replacement formula bracket will replace 90% of that amount, the second bracket 32% of that amount, and the last bracket will replace 15% of that amount. Let's review a practical example by placing our amount into the income replacement brackets. In our previous example, we got the average lifetime monthly income of $4,356. We'll apply this amount to the bracket. The first bracket that we put this in, if you've earned $1,024, 90% of that will be ours to keep. We set that aside. That would be $921.60 in our example. Looking at the second bracket, we have to subtract that $1,024 that we used in the first bracket from our initial $4,356. This gives us $3,332. Now 32% of that amount is also ours, so we put that $1,066.24 to the side. If we had an average monthly earning of over $6,172, we would get to keep 15% of that amount. But in our example, we do not. When we add the brackets that we get to keep, $921.60, and add that to our $1,066.24, that gives us $1,987.84. That's what our Social Security benefit would be if it were claimed at full retirement age.
The next thing that determines our benefit amount is when we take our Social Security. Everyone has a full retirement age as determined by the Social Security Administration. And if you review the chart on this slide, it'll show you what your full retirement age is currently. If you claim your benefit prior to your full retirement age, there's a permanent reduction on your monthly benefit. If you wait until after your full retirement age to claim benefits, there's an increase in that monthly benefit up to age 70. The reduction and increase are not figured using the same formula. The reduction for claiming your Social Security benefits prior to your full retirement age can be as much as 30% if you claim at age 62. The reduction for claiming is a permanent reduction. However, there are still many good reasons to claim your benefit early. You must consider your health, work, and family history. These are critical to determining when you should take your benefit. Someone who is claimed early may receive smaller payments, but perhaps they'll receive more of them. The increase if you claim your Social Security benefits after your full retirement age is approximately 8% if you wait until you're after 67. However, after age 70, the benefit amount will not increase. So make sure if you're waiting to take your benefits, you don't wait past age 70. It should be said, if you're adding new highest salaries or highest years of earnings to your 35 highest years by continuing to work past that age, you're still increasing your benefit. This graph is a good representation of how the reduction and increase in benefit amounts can be affected by when you claim them. See how a normal benefit at full retirement age is $1,000? If I claim at age 62 with a 30% reduction, then my benefit amount would be $700 a month. Conversely, if I could wait till age 70 to claim my benefit, my monthly benefit is going to be $1,240 a month. When to take your benefit is a personal choice that should be based on your individual financial situation. Another increase in our benefit is the COLA, or cost of living adjustment. The COLA is 5.9% this year, and that's based on the Consumer Price Index, or CPI. Eligibility for a COLA starts the year a person turns 62, even if that person does not claim benefits at that point in time. We're going to talk more about the COLA a little bit later in the presentation.
Let's talk briefly about the earnings test reduction. The earnings test reduction is going to apply only to certain individuals. Those individuals will need to have applied and started taking their benefit early. They will also need to continue work and to continue earning. Now, this does not encompass any retirement income that you may be getting from a pension plan like an NPERS annuity. It is also not a permanent reduction like the reduction for taking your benefit early, say at age 62. At the point in time when you reach your full retirement age, the earnings reduction will no longer apply to your benefit. Your benefit will also be recalculated, and what has been withheld will be put back into your benefit amount continuing forward. From full retirement age, you're responsible for reporting the need for this reduction to the Social Security Administration. Let's look a little bit more at the earnings test reduction. In 2022, the earned income limit is $19,560. So if you took your benefit early and you're working at a job at which you earn over $19,560, for every $2 over that limit, Social Security is going to keep $1 from your benefit. Let's look at an example of this that'll help us understand the earnings test reduction a little bit better. If our Social Security benefit is $1,000 that we took prior to full retirement age, and we earned an estimated $22,000 in earned income this year, we'll need to subtract the earned income limit of $19,560 from that amount, which gives us $2,440. Now remember, they're only going to withhold $1 for every $2 that were over that limit, so we have to divide that amount by 2. That gives us a reduction of $1,220. It's important to note that the Social Security Administration will withhold a whole benefit payment to satisfy the reduction. So if our benefit is $1,000 a month, then they will withhold 2 benefit payments. At the end of that year, the remaining $780 will be returned to us. The earnings test reduction, as we mentioned before, no longer applies once you reach full retirement age. The earnings test reduction is also not permanent. The reduction for taking your benefit early is permanent.
Let's talk about federal taxes on Social Security. How can we tell how much of our Social Security benefit will be taxed? For the year 2022, our combined income will fall within certain brackets that will tell us how much of your Social Security benefit will be considered taxable. To figure out our combined income, we need to know our adjusted gross income. We also need to know 1/2 of our annual Social Security benefit. And then we need to know if we're going to have any non-taxable interest. Now, non-taxable interest is generated by things like municipal bonds. It's also of note that the earnings reduction test does not include annuity payments from your NPERS plan. That is for earned income. AGI will include those payments. For the AGI, we're going to use our combined income. Payments from your NPERS annuity will be included in figuring your AGI. Looking at our example, if our adjusted gross income is $30,000, we have no non-taxable interest, and our Social Security benefit for this year is $18,000, half of which would be $9,000. We add those all together, $30,000 plus 0 plus $9,000, $39,000. $39,000 will be our combined income. Now we take that $39,000 of individual combined income back to the brackets for taxation that we showed in a previous slide. Because we earn over $34,000, 85% of our Social Security benefit is subject to income tax. So we take our adjusted gross income, we add that to $15,300, which of course is 85% of our Social Security income, for a total taxable income of $45,300. That $45,300 will determine which income tax bracket we will be paying taxes from. Nebraska is also one of 13 states in the nation that taxes our Social Security benefits. In 2021, legislation was passed that will gradually phase out the Nebraska income taxes on Social Security. It began with a reduction of 20% in taxation in 2022 and will continue to go down 10% per year until reaching 100% or zero Nebraska taxes withheld from our Social Security income in 2030. Should you have questions about the Nebraska taxation applied to your Social Security benefit, you may want to contact the Nebraska Department of Revenue.
In speaking about Social Security, we must address an issue that everyone is concerned about: solvency. People want to know if the program will be solvent enough to be around when they're old enough to take benefits. One factor affecting the solvency of Social Security is life expectancy. When the Social Security program started in 1935, the life expectancy was 12.5 years past age 65. Right now, it's over 20 years past age 65. Another factor is that Social Security was also expanded to include more benefits. And finally, a growing number of the baby boomer generation are now taking their benefit at this time. There was a Pew Research study done that indicates that millennials in the workforce have outnumbered the baby boomer generation 72 million people to 71,600,000 people. And that was according to a research study done in April of 2020. Now what that means is we will still have payroll or FICA taxes coming in to be then distributed as benefits. If Congress does nothing, according to the Social Security Administration, after the depletion of the Reserve Trust Fund in 2034, continuing income would be sufficient to pay 78% of program cost, declining to 74% for 2095. Congress has already done some things to help with the solvency of the Social Security program. They've increased the full retirement age to 67, and we're also taxing Social Security benefits at this point in time. But some things Congress might do: they might increase the FICA taxes. They could increase the tax percentage, that's the 6.2% that we discussed earlier, or they could increase the income cap. That's the $147,800 we previously discussed. They could also increase the full retirement age once again, or they might decrease benefits. All of these things would make the Social Security program more solvent. Another thing that could be changed or adjusted to help the solvency of the program would be the cost of living adjustments. When we talked about cost of living adjustments earlier in the program, we discussed how they're attached to the CPIW, that is the Consumer Price Index for the urban wage earners and clerical workers. Basically, with the CPIW, we're looking at a large basket of goods and services, and there may be many things in this basket. Services such as a haircut, a gallon of milk, or the price of a tank of gas. These things are then measured against this very same basket containing the very same services and goods from the previous year to give us an idea of what inflation might look like. We could use the chained CPI or the CPIU to figure COLAs for Social Security benefits instead. The chained CPI looks at that same baskets of goods and services. However, it takes into account that when a product or service becomes too expensive, people may substitute a cheaper version of that good or service. An example of this would be should you go to the store and you always buy a brand name box of cereal, but unfortunately when you go to the store this time, the brand name cereal has gone up $2 a box. In that case, you may look down the aisle and decide to buy the generic version of that cereal instead. That would be a substitution. With these substitutions taken into account, the CPIU would decrease the amount of COLAs in general. We could also instead use a CPIE. The CPIE has an important difference in that it takes into consideration households who have an individual in them who is 62 years of age or older. What do you think that a 62-year-old would spend the most money on that's a good or service? Well, it would be healthcare, and once healthcare costs are taken into consideration, it's a good guess that the CPIE, when used to calculate COLAs, would probably increase them.
The Social Security Administration no longer sends out quarterly statements to all workers. If you turn 60 and you do not have a My Social Security account, they will begin sending them out to you again. The cost of these statements were turned around and put back into the budget. There are many resources available to you on the My Social Security website, things like a benefit estimator and access to your 35 highest years of earnings. They can all be found at ssa.gov. There are many good reasons for you to start a My Social Security account. You can receive personal estimates, and you can review your highest years of earnings. It's important that you go through these highest years of earnings to make sure that they match up with what you understand to be your highest years of earnings. You can also apply to receive your Social Security benefit online. To create a My Social Security account, you need to be 18 years of age, have a U.S. mailing address, have your Social Security number, and have a valid email. It's important to note that you cannot set up a My Social Security account on behalf of another individual. These must be your accounts set up by you. In getting started, you may want to consider if you have a hold or fraud alert or freeze on your credit report. The Social Security Administration uses information from your credit report to verify who is setting up the account. So you'll have to have that credit freeze removed temporarily so that they can get information from the credit report. They'll ask you a question from the credit report, information like, you had a mortgage with such and such bank, and then give you 4 multiple choice answers. After you're done setting up your account, you can put that freeze back on your credit to make sure that you're protected from things like identity theft. You're going to enter your personal data, then you're going to receive a security code from the My Social Security website. You enter that code and begin the steps. If you don't want to establish a My Social Security account, you can still use the website's many other resources, like the Benefit Estimator. You're going to enter some information onto the first screen: your name, your mother's maiden name, your Social Security number, date of birth, and place of birth. Then agree to the terms of service. This information may seem somewhat invasive. However, even though you're not starting a My Social Security account, they do need to track down your 35 highest years of earnings in order for that estimate to be personalized to you. Next, it will ask you to enter your last year of earnings. This should be an annual amount. Now, why would it ask you for something like this? Well, because it's an estimator. So the guess that it's making, using last year's earnings, is that you're going to be making that amount up until you would like to claim Social Security benefits. 3 estimates pop up for you. They are if you claim your benefit at age 62, if you claim at full retirement age, or if you wait until age 70. When you claim your benefit, of course, as we've spoken about before, can produce an increase or a reduction. You can see in the middle column that it says, from now until. Then it lists the amount that you put in on the previous screen for your last year's earnings. However, what if you're done working right now? You click the Add New Estimate button. In the example we did, we put in age 62. Then it's going to ask you for your future earnings, what those would be. In this example, we're done. We're going to put a 0. The new estimate is going to go to the top of our estimates on the next screen. As you can see, it says 0 from now until when you would claim at age 62, and gives you an estimate monthly for that. You can get all of these estimates and add up to 3 other estimates without creating a My Social Security account.
Another thing that you can do is apply to receive your Social Security benefit online. You can apply online if you're at least 61 years and 8 months old, you are not currently getting benefits on your record, you've not already applied, and you want to begin future benefits within the next 4 months. The Social Security Administration also provides a 1-minute long video which will help you to understand how to apply for your benefits online. Once you've gotten through those screens, it'll ask you if you'd like to start a My Social Security account. You can click Start a New Application for your benefits online, or you can return to your application after you've worked on it at any point in time. It helps you to skip the lines and not have to go into the Social Security Administration. Of course, they're there if you have questions, in which case this last slide that we've put in our presentation lists all of the local phone numbers for your Social Security Administration in your community. If you'd like to set up an appointment, you can certainly give them a call if you need to have someone in person speak to you. We hope that you've enjoyed this presentation and found it both informative and enjoyable. Thank you so much for your time.